Welcome to Cashflow Positive, your go-to channel for all things finance. Today, we're embarking on an exciting journey into the realm of investing, specifically focusing on exchange-traded funds, or ETFs, and mutual funds. These two investment vehicles are fundamental to any investment portfolio, yet they remain shrouded in mystery for many. But fear not. By the end of this video, we aim to demystify these concepts, giving you the confidence and knowledge to make informed investment decisions. We'll explore what ETFs and mutual funds are, how they differ from each other, and how you can start investing in them. We'll also debunk some common misconceptions about these investment options. Understanding these concepts is crucial because they can provide a balance of risk and return, and potentially open doors to diverse investment opportunities. So, buckle up as we dive into the world of ETFs and mutual funds. First off, let's tackle ETFs or exchange-traded funds. Picture an ETF as a basket, but instead of fruits or chocolates, this basket contains various stocks, bonds, or commodities. You're not buying a single apple or orange, you're buying a whole basket of assorted fruits. In the world of finance, this means you're investing in a collection of securities that often tracks an underlying index. Now, let's delve into some of the characteristics of ETFs. Unlike individual stocks that fluctuate throughout the day, ETFs are traded on an exchange just like a company stock. This means that the price of an ETF's shares will change throughout the trading day as the shares are bought and sold on the market. What makes ETFs particularly appealing is their lower expense ratios. While no investment is free of costs, ETFs generally tend to be more cost-effective than their mutual fund counterparts. This is because they are passively managed, aiming to mimic the performance of an index rather than actively trying to outperform it. Another key advantage of ETFs is their flexibility. They offer the diversification of mutual funds while also providing the ability to trade throughout the day like individual stocks. This means you can buy or sell ETF shares on a stock exchange much like you would a regular stock. Moreover, ETFs are known for their tax efficiency. Due to the way they are structured, investors can often avoid the capital gains tax that comes with buying and selling securities. This can make ETFs a more attractive option for those looking to maximize their returns. Lastly, ETFs allow for targeted investments. Whether you're interested in a particular industry, commodity, or region, there's likely an ETF that aligns with your investment goals. In essence, ETFs offer a way for you to dip your toes into a pool of diverse investments. They give you a chance to spread out your risk while still offering the potential for a solid return. And who doesn't like the sound of that? Now, let's shift gears and talk about mutual funds. Imagine you and your friends want to buy a fancy cake, but it's too expensive for any one person to afford. What do? You all chip in, pool your money together, and buy that cake. This is the basic idea behind mutual funds. A mutual fund is a type of investment vehicle where many investors pool their money together to buy a broad range of assets like stocks, bonds, and other securities. But who decides what to buy? You wouldn't let just anyone pick out your fancy cake, right? Well, in the case of mutual funds, a professional fund manager handles this job. These managers use their expertise to select investments that align with the fund's goals, which could be anything from aggressive growth to income generation or even capital preservation. So, what are the benefits of investing in mutual funds? First, they offer diversification. Instead of putting all your eggs in one basket, or in this case, all your money in one stock, mutual funds spread the risk across a variety of investments. This diversification can help buffer against the ups and downs of the market. Second, mutual funds provide access to professional management. Unless you're a finance whiz with plenty of time on your hands, it might be challenging to manage your own portfolio. With mutual funds, you get the benefit of a team of experts making informed decisions on your behalf. Lastly, mutual funds are accessible. You don't need a fortune to start investing. Many mutual funds have low minimum investment requirements, making them a great option for beginner investors. But remember, like all investments, mutual funds come with their own risks. The value of your investment can go down as well as up, and it's possible to lose some or all of your initial investment. So it's important to do your research and consider your risk tolerance before investing. So, mutual funds are like a professionally managed basket of investments. You might be wondering, how do ETFs and mutual funds compare? Well, let's dive right in. Both ETFs and mutual funds pool investors' money to buy a diversified portfolio of stocks, bonds, or other assets. This allows investors to gain broad exposure without having to buy each individual security. However, there are some key differences that might influence which one is right for you. Firstly, let's talk about how they're traded. ETFs are traded on an exchange, just like individual stocks. This means you can buy and sell ETFs anytime during the trading day at market price. On the other hand, mutual funds are bought and sold at the end of the trading day at the fund's net asset value, regardless of what time you placed your order. What about costs? ETFs generally have lower expense ratios than mutual funds. An expense ratio is a measure of what it costs an investment company to operate a mutual fund or ETF. However, when you buy or sell ETFs, you may have to pay a brokerage commission, just like you would with a stock. Mutual funds, on the other hand, often have minimum investment requirements and may charge a sales load, which is a commission for buying or selling the fund. Next, let's discuss transparency. ETFs are more transparent than mutual funds. They disclose their holdings on a daily basis, while mutual funds only do so quarterly. This means with ETFs, you know exactly what you own and how much of it every single day. And then there's tax efficiency. ETFs are usually more tax efficient than mutual funds. This is due to the in-kind creation and redemption process of ETFs, which often avoids triggering capital gains. In contrast, when mutual fund investors redeem their shares, the fund may need to sell securities, potentially generating capital gains for remaining investors. However, there are also some similarities. Both ETFs and mutual funds provide diversification, professional management, and a range of investment strategies. They can be passively managed, tracking an index, or actively managed, where a manager or team makes decisions on the portfolio's holdings. So, what's the bottom line? Well, if you want to trade throughout the day, value transparency and tax efficiency, and don't mind paying a brokerage commission, an ETF could be a good fit for you. If you prefer the simplicity of buying and selling at the end of the day, plan to make regular investments, and are okay with potentially higher costs and less transparency, a mutual fund might be more your style. In short, the choice between ETFs and mutual funds depends on your investment goals and strategy. Whichever you choose, remember that diversification and a long-term perspective are key. And as with any investment, it's important to understand what you're investing in before you invest. Now that you have a basic understanding of ETFs and mutual funds, you might be wondering, how can I invest in them? Well, you're in the right place, as we're about to dive into the steps you can take to start investing in these instruments. First, it's crucial to understand that you'll need a brokerage account to buy and sell ETFs and mutual funds. A brokerage account is essentially a financial account that allows you to buy and sell a variety of investments, including stocks, bonds, and of course ETFs and mutual funds. There are many brokerages to choose from, each with its own strengths and weaknesses, so it's essential to do your research and find one that fits your needs. Once you have your brokerage account set up, you're ready to start investing. But hold on, don't rush into buying just yet. It's important to have a clear investment strategy before you begin. This could be based on your financial goals, risk tolerance, and investment horizon. Let's say you've decided to invest in ETFs. Your next step would be to identify which ETFs align with your investment strategy. You can do this by researching various ETFs, looking at their holdings, performance history, expense ratios, and other relevant factors. Once you've identified the ETFs you're interested in, you can buy them directly through your brokerage account. Investing in mutual funds follows a similar process. You'll need to identify which mutual funds align with your investment strategy, researching factors such as the fund's performance history, the fund manager's track record, and the expense ratio. Once you've chosen a fund, you can buy shares directly through your brokerage account. One key difference between ETFs and mutual funds is how they are traded. ETFs are traded like stocks, meaning you can buy and sell shares throughout the trading day at fluctuating prices. On the other hand, mutual funds are only traded once per day, at the end of the trading day, at a price known as the net asset value. Another important point to note is the role of trading platforms. These are digital interfaces provided by your brokerage that allow you to execute trades, monitor your portfolio, and access various research tools. Some brokerages even offer robo-advisors, which are automated investment platforms that can create and manage a diversified portfolio for you based on your investment goals and risk tolerance. Investing in ETFs and mutual funds can be a great way to diversify your portfolio and potentially earn returns over time. However, like all investments, they carry risk and it's possible to lose money. That's why it's so important to do your research, understand what you're investing in, and have a clear investment strategy. Remember, it's important to do your research before diving into any investment. After all, the more informed you are, the better decisions you'll be able to make. So, happy investing, and may your portfolio prosper. Before we wrap up, it's important to debunk some common misconceptions about ETFs and mutual funds. Let's start with exchange-traded funds, or ETFs. A prevalent myth is that ETFs are always cheaper than mutual funds. While it's true that ETFs often carry lower expense ratios, the total cost of ownership can sometimes be higher due to trading fees. Moreover, not all ETFs are passively managed. There are plenty of actively managed ETFs that aim to outperform the market, just like mutual funds. Another misconception is that ETFs are only for short-term trading. While their intraday trading capability can be attractive to day traders, many investors use ETFs for long-term strategic positions in their portfolios. ETFs provide a flexible, cost-effective way to gain diversified exposure to a particular market segment or investment strategy. Now, let's move on to mutual funds. One common myth is that mutual funds are only for the big guys or wealthy investors. This is far from the truth. Many mutual funds have low minimum investment requirements, making them accessible to investors of all sizes. Another misconception is that all mutual funds are actively managed. In reality, there are index mutual funds that passively track a specific index, similar to many ETFs. These funds can offer lower costs and a more predictable performance pattern compared to their actively managed counterparts. Perhaps the most dangerous myth is the notion that higher risk equals higher returns. While it's true that investing in riskier assets can potentially yield higher returns, it's crucial to remember that they can also lead to greater losses. It's all about finding a balance that suits your risk tolerance and investment goals. In conclusion, it's crucial to understand that ETFs and mutual funds are not inherently good or bad. They are simply tools that can help you achieve your investment goals. Like any tool, their effectiveness depends on how well you understand and use them. Always remember, informed investing is smart investing. And there you have it, a basic understanding of ETFs and mutual funds. As we've journeyed through the world of investing, we've delved into the intricacies of ETFs and mutual funds. Two seemingly complex concepts, yet, with a bit of patience and knowledge, they've become more familiar, more accessible. It's like unlocking a secret door, behind which lies a world of financial opportunities. In essence, remember that an ETF, or an exchange-traded fund, is a type of investment fund and exchange-traded product, traded on stock exchanges. ETFs are unique because they offer the diversification of an index fund and can be bought or sold throughout the day like a regular stock. On the other hand, mutual funds pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. Unlike ETFs, mutual fund shares are bought and sold at the end of the trading day at the fund's net asset value. We've also explored the key differences between the two, from how they're traded, their pricing structure, to their tax implications. All these elements come into play when deciding which investment route is the best fit for you. And let's not forget, we've touched on how to invest in ETFs and mutual funds, a step-by-step guide from opening a brokerage account to choosing the right fund. It's a process that requires careful planning, but with the right tools and knowledge, it's a process that can lead to financial growth. We've also debunked some common misconceptions about ETFs and mutual funds, misconceptions that often deter potential investors. But remember, understanding these concepts is key to making informed investment decisions. So as we wrap up, let's keep in mind that investing is not a one-size-fits-all approach. It's about understanding your financial goals, risk tolerance, and investment horizon. It's about making informed decisions. And most importantly, it's about taking that first step towards financial literacy. If you found this video helpful, consider subscribing to Cashflow Positive for more interesting facts on finance. Don't forget to hit the thumbs up button as it really helps the channel. Remember, your journey to financial literacy starts here. Until next time, stay Cashflow Positive.